Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I had a very important and really great conversation with a friend of mine. We talked about a lot about the stock market and so on. He used to be one of those people who invested in penny stocks and so on. Now he just buys ETFs because he got burnt a lot. And one of the things that we talked about was, he said, do you know what, I've done all the mad stuff that I could have done during 2020, 2021. I got burnt out, and now I'm actually ready to invest in the stock market, the ETF side of things. And he's been doing that for a couple of years now, and alhamdulillah, he's doing really well. And then he asked me a question. He said, you're always talking about passive income, you're always talking about dividend companies. Don't you think that, in terms of total returns, you're actually missing out a lot? And I said, do you know what, I don't genuinely think I'm missing out a lot, and there is a reason as why, and I can explain that to you. And that's exactly what I did. And at the end, he was like, do you know what, fair enough. I actually had to show my portfolio. He doesn't watch the channel. He knows that I basically exist, and he's actually subscribed and everything. But he, of course, we had conversations. Why does he need to watch the videos? Normally anyway. So one of the things that basically we talked about was, I showed him my portfolio, and we talked about individual stocks, we talked about the ETF side of things, and we talked about specific companies that in my portfolio that are more of a high growth companies rather than in dividend paying companies. So then I thought, you know what, every single portfolio out there needs some sort of a high growth companies. And what I'm going to do today, the whole purpose of just giving you that information is the fact that I'm going to give you information, basically 10 to 15 different companies that are in different tiers of high growth companies. So there are types of high growth companies that are very profitable businesses. They've been around for a very long time. They are mega cap companies. Then you've got the mid-tier companies where they're very profitable. They've been around for quite some time. They're establishing themselves right now. And then you've got the high flying companies that are, some of them are still not profitable, some of them just became profitable. So I've got 3 different tiers of basically high growth companies to share with you guys today. So after that long-winded introduction, I want to share with you guys 5 companies first in this first tier that are mega cap companies that potentially will help you grow your basically portfolio way more than if you didn't have them in your portfolio. And I'll explain basically this whole thing in a second. So let's have a look at the S&P 500. Let's have a look at the Nasdaq, because that's where basically we're starting from. Because a lot of these companies are, of course, they are in the S&P 500, but a lot of them are in the Nasdaq 100 or composite, whatever. 33.5% up a year to date in comparison to basically 26% the S&P 500. So they are outperforming the S&P 500 by, about at least 10%, which is quite nice to see, almost 10%. And sometimes it's more than that. Okay, if we look at it for the 1 year, this is 30%, this is 24%, so about 5%. And the last 5 years, this is where it becomes apparent to all of us that the Nasdaq is better, basically in terms of total returns, than actually all the other indices out there. 84% for the S&P 500, 50% for the Dow Jones, 119% for the Nasdaq, 6% for the FTSE 100. So as you can see, there are a lot of companies in here that are very high flying companies and have done absolutely amazing job over the last whatever years. And it is important for us to keep an eye on those companies and potentially add them to your portfolios. And I'm not saying make these companies, 20-30% of your portfolio, 100% or whatever of your portfolio. Make this about to 30-40% of your portfolio, and then the rest of them you could do whatever you want to do. Maybe if you've got ETFs, you can balance between ETFs, the dividend-based growth companies, as well as some of the companies that we're going to talk about. Now, some of the companies we're going to talk about today do actually pay dividends as well. So let's just go back. So like I said, this is some companies that you could potentially consider yourself basically moving forward if you're thinking basically, inshallah, in the long run, you want to have a portfolio of basically high growth companies, dividend paying companies, and some ETFs potentially to beat the market or even basically do as well as the general markets like the S&P 500. So What are we looking for? We're looking for the market cap, so that tells us how big the companies are. We're looking for the moat rating, which is quite important. Okay, wide moats, basically narrow moats, is normally what we're looking for. Free cash flow here is important because a lot of these companies do need to have free cash flow for us to be able to feel, you know, comfortable that we know the company has got enough cash to potentially pay off any debt that they have, reinvest in the business, whatever it is. Okay. Gross profit margin is very important, and I'll explain exactly what that is in a second. But it's basically it's the profitability metric that we use that helps us understand how much of, let me quickly show you. I'll actually demonstrate this with an example. We're using Broadcom, which is one of the first company we're going to talk about. So financials, if you go to total revenue here, so this is the revenue the company makes. And this is how much they invest, basically, sorry, how much they actually invest in basically to make this much. Okay, so what is left is the gross profit. So what we're looking for is the percentage of this. Okay, what percentage is basically this bit here, and basically gross profit is the gross profit here divided by the revenue, which is basically this divided by that, will give us the percentage that we're after, and I'll show you exactly in a second. The next part that we're looking for is the net income, and the net income again is very important because it's the measure. Basically, it helps us measure, basically as expressed as a percentage of how much net income is generated from every dollar of revenue. So every dollar of the company that company makes, how much of that basically how much, whatever the revenue is, how many dollars. So what you do is basically you look at the total revenue here. Okay, so every dollar here, how much of that are we actually taking as profit? So every single dollar that we basically generate from this revenue, how much of that basically is our profit basically, and the higher, of course, the better for us. The final thing I'm going to talk about is the return on equity, and return on equity is again very important because it shows us how competent the management is in investing basically the money that we have to actually generate more money, the money that the companies generates, and the money they get from us, the money they get from, you know, selling their product. How much of that are they kind of reinvesting into the business to actually generate more revenue, more profits for us, if you like. There you go. That's the long-winded of conversation, basically explaining. I should have written these things down and just read it out to you. But there we go. Revenue growth was basically we're looking for the next year, and then also the EPS growth for the next year as well. Morningstar valuation, just to give us an idea where these companies are. The first one you've already seen is Broadcom. Broadcom currently has $241 per share, and it has $1.1 trillion right now market cap, which is absolutely crazy. It has a wide economic moat. Free cash flow right now $19 billion, $19.4 billion, and gross profit, check this out, 75% gross profit. So we've already seen the company. Okay, so this is basically how much they're making. This is what they're basically spending. And the $38.7 billion is basically that 75%. If you actually convert it to, basically, if you divide the gross profit by revenue, that's what you will get, the 75%, and times it by 100, of course. The net income is 11% right now, return on equity of 13%. Again, these are very, very high. So the net income could be higher, and the return on equity is actually decent. Anything above 10 return on equity is actually okay. Revenue growth estimate for next year is about 15%. The EPS growth is about 20%. And right now it's a bit expensive, but it's $190 per share. Now, let me just explain one other thing. The other things that we need to consider is when we're talking about these things, right now, we're starting basically 2025 is coming soon. Easily things can change. In 2021, everything was going to the moon. We had an amazing year when it comes to stock market. 2021, the first trading day, the stock market went down. And guess what went down a lot? Was the technology companies. And they've never recovered that year. They were actually going down every single basically month. They were going down and down. The only companies that were doing an absolutely amazing job was the energy sector. So that can happen easily. And if that happens, and I'm not saying Broadcom is going to go down 40-50%, but it can happen. And we've seen it happen previously. The next one is NVIDIA. Again, $3.3 trillion company. It has a wide economic moat. It's the leading company when it comes to AI, and this is the second leading company. So if you own one of these companies in your portfolio right now, you are really smiling. I am smiling right now, to be honest, because I do own Broadcom in my portfolio. Now, $56.5 billion of free cash flow right now. That's just ridiculous. Gross profit, we're looking at about 76%. So if we go here and type NVDA, you will see is very similar to this. $113 billion of revenue, 27 billion basically of that is how much they spend. Let's call it $86 billion of basically gross profit right now, which is ridiculous. Net income 56%, 127% when it comes to return on invested capital. They're expecting the earnings to grow, basically EPS to grow about 51% and earnings to grow about 50% next year. Fairly value right now, $130 per share is where they think the price should be. The next one that we're going to talk about today is Tesla. I don't own this one. I've sold it for political reasons, so I left it alone. But Tesla is another one. $1.3 trillion as well. Narrow economic moat. Currently $3.6 billion of free cash flow. Gross profit 18%, which is not bad. Net income 13%. Return on equity 20%. 17% growth expected in terms of revenue side of things. EPS about 31%. 116% premium right now. $210 per share is where they think the price should be. Right now it's basically $432. And we all know why it's up. I'm only giving you this information just to give you some ideas of some of the companies that you could potentially add to your portfolio to make sure you beat the market, or at least have a basically 7 to 10%, if not higher, return on your basically investment in the long run, inshallah. So Apple is the next one. $3.8 billion of basically trillion dollars of market cap right now. We know it has wide economic moat. Currently has over $108 billion in free cash flow, which is absolutely ridiculous. They can actually take that money and buy a lot of the companies that we're going to talk about today. Profit margin, we're looking at 46%. Again, very high. This is why these companies are very expensive, because look at these numbers here. When you see something like this, you don't expect the companies like this to be trading cheap right now. Revenue growth for this company, we're expecting about 8% next year, 12% when it comes to EPS, 30% premium right now, $200 per share is where they think the price should be. If we see a bit of a drop, that can easily happen. 20%, 30%, it can easily happen. The final one is Visa, the smallest out of all of them, and that's $626 billion market cap. But that's not small, but in comparison to these big boys, it is. Again, $18 billion of free cash flow, profit margin 98%. There's some companies on this list today that have a profit margin of basic gross profit margin of 100%, which is ridiculous. The net income margin is 55%, 51% when it comes to return on invested return on equity. 10% expected in terms of revenue side of things, growth wise. Y side of things, EPS 13% fairly value, $218 basically $9 per share is where they think the price should be. So that's the first tier of companies that we wanted to talk about today. Let's now have a look at the second tier of companies. So these companies are generally, they are similar to the first round of companies that we looked at, but it's slightly smaller. They're still profitable and so on. Tier 3 is where you will meet some companies that are not profitable and maybe a little bit more risk, carrying a little bit more risk. And the first one is basically MasterCard. If you see a Visa, you're going to see MasterCard in any basically comparison, whatever, because they're very similar in terms of business wise. And as you can see, 490 billion market cap right now, wide economic moat, $12.8 billion of free cash flow, 100% gross profit margin, which is ridiculous, net income margin of 45%. Again, if you don't believe it, let me show you actually this. Let me just quickly show you where this information comes from. So if you go to Seeking Alpha and you scroll all the way down, there you go. Gross profit margin of 100%, which is crazy. Return on equity, we're looking at 178%. And next year, they're expecting the revenue to grow about 12%, 13% when it comes to EPS, 15% premium right now, $465 per share. Again, another great company, potentially will actually help you in the long run. Another one is basically Salesforce, another one that I own in my portfolio, $332 billion of market cap right now. Wide economic mode, almost $12 billion of free cash flow, 77% when it comes to gross profit margin. A lot of these technologies companies, they do have this in common, gross profit margin. Because why is that the case? Because if you think about this, right, it is that happens because they don't have a lot of overheads. They don't spend a lot of money. Okay, so for a company like Salesforce, if you click the income, you will see they made $37 billion in terms of total revenue, and they only spent $8 billion, right? $28 billion was gross profit. Okay, but they spend a lot of money when it comes to sales, which basically Salesforce has this crazy and advertisement and so on. So they spend a lot of money on that. But majority of the money basically they spend is research and development. And because these companies, that's what they are. They actually innovative companies, or they innovating all the time. So for that reason, they have to spend a lot of money. But in terms of net income, 16%, return on equity is decent, 10%. And this is growing every single year. Revenue growth expected to be about 9% next year, and 12% when it comes to EPS. Fairly valued right now, $315 per share. So if we see about 10% drop in the stock market next couple of months, then I will be buying more of this company. I promise you that much. Next one is very similar to Salesforce. It's basically ServiceNow. It's another one that's on my watch list. Currently 222 billion market cap, so it's slightly smaller than Salesforce. Wide economic mode as well, $3.3 billion of free cash flow right now. Gross profit 79%, net income 13%, return on equity, net income margin that is, and return on equity 16% for the trailing 12 months, by the way, all three of them. Revenue growth expected to be about 21% next year. EPS is expected about 19%, 22% basically right now. Premium, $900 per share is where they think the price should be. Right now it's slightly over 1,000. Next one is Adobe. You might be thinking, why is Adobe included in this list? It's because of these things. If you look at the basically when it comes to gross profit margin, net income, return on equity, as well as the growth expected next couple of years, and the fact that it's discounted right now, it's a good price. $590 per share is less than 200 billion market cap. But again, another great company that's been around for quite some time that would potentially, it hasn't done much, to be honest with you, for the last year or so. But in the long run, I'm sure this company will bounce back. So if you look at for the 1 year, 25% down. So again, value play if you like. And final one is Intuit, another company that I own in my portfolio, 178 billion market cap. It has a wide economic mode. Free cash flow right now, $5 billion. Gross profit, 80%. Net income 18%, return on equity 17%. Again, check this out, 12% double-digit growth expected next year. And then basically EPS also in terms of revenue and in terms of EPS as well. Fairly valued right now, $640 per share right now. 640 is exactly where it is. So it's slightly to basically higher than where it's basically slightly lower than where they wanted it to be, which is very interesting. So that's the second tier. Again, all of these companies that we've seen so far, very profitable businesses, been around for a very long time. And of course, you can expect them to basically do well over the next whatever years to come, inshallah. Now we get into the side where some of these companies might not be as profitable. But the first one that we're going to look at today is started to become a profitable. That's Uber. Right now, 128 billion market cap. It has a narrow economic mode, about $6 billion of free cash flow, which is good. Gross profit margin, we're looking at right now 33%. Net income of 10%, return on equity 34%, and revenue growth expected to be about 16% next year. EPS about 23%. Again, is discounted right now about 22%. $79 per share is where they think the price should be. So another great company, is profitable, is starting to pick up, is on my watch list. So I don't know. I'll see. I need to do a little bit more research to be able to feel comfortable, because the reason I said that is because there's a lot of competition from Waymo, for example, Teslas, and of course around the world there are other apps very similar to, no matter where you go, you'll find an app that's very similar to Uber and doing exactly what Uber is doing. So in the US there's a competition, around the world there's definitely massive competition. So I'm not sure in the future, so that's the only reason I'm still holding on. But right now it looks decent, and it is actually 22% discounted according to Morningstar valuation. Next one is AMD. I've included this company in this list, on this list, because it is been around for quite some time, but when it comes to free cash flow, profitability side of things, or return on equity and things like that, it hasn't done amazingly. But they are also expecting to grow massively, 27% next year in terms of revenue, 53% in terms of EPS, and as you can see, it's 22% discount right now. $160 per share is where they think the price should be. So it's a great play. If you are genuinely do not own any semis, this is potentially a good one to have. If you own some of the ETFs, for example, SMH, basically ETF, then of course you don't need this. But if you don't own that, potentially this is a good one to add to your portfolio. Again, I'm not a financial advisor, so please be mindful of that. The next one is CrowdStrike, one of the companies that I wish I'd never sold. I took some profit off the table at some point a while ago and I sold it. Right now it's 88 billion market cap. I think it's down quite a lot today because the general markets are actually down a lot today, so that's probably why. So 88 billion market cap, $356 per share right now, $1.1 billion of free cash flow, which is quite nice. Gross profit 75%, net income 3%, return on equity 5%. So it's getting there, but they're expecting the earnings to grow double digits basically next couple of years. So 21% next year in terms of revenue, 17% in terms of EPS, 22% premium right now, $300 per share is where they think the price should be. That's only $56 higher than where it is right now. Basically higher than where it is right now. So generally, if we see a drop in the market, this company could become a fair valued or even discounted at some point. But great company, one of the best when it comes to cybersecurity side of things. So I really like the business model. I did own it at some point, and it's basically gone up so much I sold it, and it was very risky business. A lot of these companies here are quite risky, so you carry in that risk. Zscaler is another one that's basically in the similar sort of a sector. Currently it has 28 billion market cap, so it's slightly smaller. It has a narrow economic moat, 652 million in terms of free cash flow. In terms of profit margin, we're looking at about 78%. Net income, return on equity and things like that is not there yet because the company has not become a profitable business yet. Revenue growth, so this might be higher, but after in fact, let me show you. Okay, the reason why this happens is because a lot of these companies, they do have a they've got revenue, and they are basically, gross profit is right now 1.7, so they only spending 500 million after they made $2.2 billion. But of course, after they've done all of these things, the net income is still negative and EPS is still negative. So they're not actually profitable businesses yet. That's why there's no net income. Return on equity is still not there yet. So revenue, basically, they're expecting to grow at about 20% next year, 20% in terms of EPS. Fairly value right now, $213 per share is where the price should be. Right now, we're looking at about $184 per share. Very risky business again, these companies. So be mindful of that. And finally, Cloudflare. Again, another one that I used to own, I think when it was like $30, $40, whatever, and it's gone up a lot, and then I sold it. This was early 2000. I think this is before YouTube and stuff. I've started YouTube, I think. 37 billion market cap right now, so it's slightly bigger than this one. Narrow economic moat, in basically a few $1 million in the bank right now in terms of free cash flow. Gross profit, again, really good, but not profitable. They're expecting the earnings to grow and EPS to grow double digits next year. So 26 in terms of revenue, 14 in terms of EPS, 29% and right now premium, $87 per share is where they think the price should be. So a lot of these companies have a couple of things in common. Okay, so the first round of companies that we've seen is the mega cap companies, huge companies, very profitable. They're expecting the earnings to grow nicely. A lot of them are very expensive right now for good reasons, and they all have excellent free cash flow. The second round are very similar but slightly smaller, but they're also very profitable businesses. They grow in double digits, slightly cheaper if you think about it. Okay, this tier of companies are the companies that are slightly more risky, if you like, because what you're buying right now is basically you're buying these companies hoping that they're gonna do what they said, number one, in terms of revenue and so on, and of course become profitable businesses in the long run. So you buy it now, you hold it for like good 10 years. So you have to take a bit of a risk, and that's why I wouldn't do it 40-50% of my portfolio this type of companies, because in 2022, anyone who owned this type of businesses lost a lot of money. And there was so many companies. There was a huge list. I think it was Twitter or something I saw once. And a lot of the companies, including some of these companies, have lost so much value during basically 2022. So that can easily happen. So bear that in mind. But like I've always said to you guys, you need to have a balanced portfolio if you are doing stock picking, and of course include some of these mega companies on your portfolio. So inshallah in the long run it balances things out. And that's what I'm trying to do in my own portfolio, because I do own some of these type of businesses. And just to kind of be honest and transparent with you guys, right now my biggest holding is basically Broadcom. Again, another great company that was undervalued when I bought, but right now is up so much. Visa is another company that I own in my portfolio. Salesforce is there. What else is here? MasterCard is here. ASML. So I do have some of those technology companies, but I also have the other companies, that the oil companies that are not doing well right now, but potentially might be coming back if we see basically Trump digging more oil or whatever, if things change for them. So you have to bear that in mind. Now, if you're still here, I appreciate you, absolutely, genuinely appreciate you. Thank you, for watching this far. And if you can join us in the Patreon account, it will make absolutely huge difference to me. So if you can do that, that would be absolutely amazing. Apologies for my voice because it's still all over the place, but inshallah in the next couple of days I'll get better, and then I will be recording a lot more videos for us, inshallah. That's what I wanted to share with you guys. Please take this with a pinch of salt. This is a bit more entertainment for me, but I'm not a financial advisor. You have to make sure you do your own research, especially about some of these companies. And again, if you disagree with whether anything that I'm saying here, that's absolutely fine. But go away and do your own research, inshallah, and do what makes you happy and comfortable. In the end of the day, it's your money and you need to be careful. Okay? Have a wonderful day. Assalamu Alaikum.